In this example, we're going to prepare the 4 financial statements given a list of accounts and their normal balances from the trial balance. So it will be up to us to recognize whether the account is a revenue, expense, is it an asset, a liability, or an owner's equity account, or is it part of the cash flow statement. Each item will only be used one time. So starting out down the list, supplies, cash flow, prepaid, service revenue. I have service revenue of $65,200. The next thing I see is operating expense, $41,000. Supplies expense, $1,100. I have no rent yet. Insurance expenses there, which is $2,100. Keep looking. And there's the rent expense of $2,500. They're in random order. Okay. Now I don't see any more expenses. Looking down my list, I would total my expenses. On statements, we like to pull our totals over to the right-hand side to give them emphasis. So now my net income is revenue minus expense. Oops, wrong slot. You always put the cursor not where the I is, but where you want the answer to be. Equals revenue minus expenses. So we have a net income of $18,500. That number will move down to the statement of changes because it increases retained earnings. Now I need to look for the other accounts that have to do with equity. So looking down for equity accounts, I see common stock issued. So common stock issued would be $5,000 right here. Beginning retained earnings is $9,300. Put that in. Cash flow, don't need that. Rent expense, dividends, yep, dividends will come into play here. They're going to be a subtraction in the equation because it says less dividends. So even though it's a positive number, I am subtracting it. Cash, receivable, prepaid, unearned, land, and accounts payable. So I don't see anything else here. I need to find, oh, here it is, beginning common stock. I almost missed it. So beginning common stock was $40,000. So my equity is going to be $45,000 from stock. And my retained earnings is going to be the beginning retained earnings plus net income minus dividends, which is $24,800. Total equity is always your stock or contributed capital plus retained earnings. Retained earnings represents that amount that you have earned and retained in the business since the moment your corporation began. Now I'm ready for the balance sheet. These numbers on the stockholders' equity account have to come over to my balance sheet. And remember, you're going to bring over the ending balances, not the beginning balances. Okay, now what do we have for assets? Starting at the top of the list, we see supplies, $1,000. Prepaid insurance, that is an asset because should we cancel the insurance policy, they would have to refund that to us. Okay, looking down, what have I not used yet? I have the cash account, accounts receivable, there's the prepaid rent. Just going down the list. Unearned revenue. Unearned revenue is a liability because revenue is recognized when the work is done or the goods are exchanged. This is where someone paid us in advance for the work, so we have a liability to do the work. Should we not do the work, we owe them this $6,400 back. We have land, and then we have an accounts payable here. So let's check. Total assets, $93,200. Our total liabilities are $23,400. We're going to add liabilities to equity and make sure that they do indeed meet the total assets. So in other words, we have $93,200 in things that we own or control, and they were provided to us by borrowing of $23,400, by investors of $45,000, and we have earned and retained $24,800. These balanced, we would move on. The last few items are given for us, so cash flow from investing activities was a negative $5,200. Cash flow from operating was a positive $15,600. And cash flow from financing was a negative $5,000. So our net change in cash is $5,400. We would add that to our beginning cash, which is a plug figure was given to you, and we see that ending cash is $48,000, which agrees. Cash is $48,000. So we see that the statement of cash flow is trying to explain why, if we earned $18,500, our cash only went up $5,400. And that's because we have the payables and the receivables. Not everything was cash.